Is there anything else to go in the system to be taken out? Like all the um, all the dead bodies that have been revealed.
No, no, they haven't. There's at least a dozen firms I could name that are insolvent right now that haven't declared yet.
We are doing it. Um, so, Kyle Davies, thank you. Thank you for coming on the show. Thank you for sharing and heavens. It sounds like um, you've got quite a story. Um, and I guess with the best stories, we might have to start at the beginning. And the beginning really for you was what, 2012, where you kind of had you seed funded, you kind of called on friends, families, and accumulated a little $1 million or so, and so began the journey.
Yeah, I appreciate it. Let's start there. As the predecessor to that, um, I founded Three Arrows with a partner, Suzu, and we'd actually known each other from before. We went to high school together, went to college together, got our first job. We were derivatives traders. And after 3 years of trading at a bank, I actually really liked the role. I was an equity derivatives trader, great team. But I just realized I had an opportunity. I had an opportunity, like a shot to try something on my own. It wasn't going to be particularly high risk. If I messed up, I'd be able to get a job again. Worst case, business school. But I was young, and I could do it. So in 2012, I started Three Arrows with Suzu with $1.2 million. And our first trades were in FX markets.
And tell me more. So FX markets. So you were, yeah. Tell me more. So you were in what, EM FX markets, and you were arbitraging or whatever. That's
Yeah, that's exactly right. So it was right when banks all wanted to stream their own platforms. So whether you were Citi, Barclays, UBS, whatever, they all built their own in-house platforms, and they would distribute that to their clients, with the idea being that it would be a captive order flow, right? But the reality is, I could have all those clients could have all those platforms, but they couldn't see each other. And so for us, it was there was plenty of arbitrage. We started off just clicking platforms. We then built up some strategies that involved chats. Then we got more sophisticated, added some automation with futures markets, and finally figured out how to do the financing and onshore side as well. But yeah, over the next 3 years, we hired about 35 people, traded anywhere from 10 to 15% of the whole, they're called non-deliverable forwards. So NDF market.
Yeah. So yeah, I mean, 30 people. That's a lot. And so that
Yeah.
really was 2012 to 2017 or so. Yeah, was the FX world. And there, so with 30 people, you use this term hedge fund, right? And we'll go on and we'll explore it. Perhaps more back then you were like a hedge fund in the sense that clients, and can we discuss that?
Yeah, well, so we didn't have investors. I mean, we were regulated as a hedge fund, so it was legally a hedge fund. But in practice, we had no investors. There was one period of time where we had some external investors for about 4 months, but actually, the rest of the time we had no investors. We just we set it up that way because I came from a bank, and all of my bosses, when they set up hedge funds, they would try to scale the AUM, and I assumed we would as well. But the reality is, with our strategies, it wasn't really capital intensive. It was more idea intensive, or strategy intensive, technology intensive, things like that. And so for us, we operated very much as a prop trading firm. And so I mean, if I'm going to break down how do you get to 30 people or something like that, we had basically an India guy, a Korea guy, a China guy. We covered the night, the day. We had an in-house system. We could do automated trading with. It was a whole operation.
I didn't quite get. Again, I'm still trying to bring you into like the world that I understood, the hedge fund world that I understood. Hedge funds are pots of intellectual fascination. You're not a factory. You don't need billions of dollars to make things. I don't quite understand how you've really never had external investors. So and FX, and you had a little bit of ARB, but really because you had access across all the platforms. That could be if you could have that access, then other funds could have that access. Again, so I'm kind of thinking, well, and 30 people is a sizable operation. No extra, and you start at $1 million. You're doing 15% of trading in FX markets.
15, yeah.
Yeah, 15%, yeah. But again, where was the cap? Okay, so prime broker, you had a prime broker back then?
We had a prime broker. So we actually had a couple, but the biggest one at the time was Citibank. Yeah. And the role of a prime broker is to give you access to counterparties. So they would set up credit limits with 20 or so banks. And the idea is that you could trade with all of those, but they would be cross-margined in one place, right? And we weren't the only firm doing this, by the way. But the thing is, it's at its extreme, it's very toxic order flow, right? Because when I trade one bank against another, I could buy, let's say, a 1 month India rupee future or forward, and I could sell it with another venue, and I could lock in pips, a fraction of a percent, and the banks can't make money on that because I'd basically be buying one and selling another, right? And so for them, if you were a large hedge fund, I knew multi-billion-dollar hedge funds that were doing this. It was very dangerous because you could lose your counterparties. They would cut you off. They'd get very angry, right? And so for us, it was a game where you needed to figure out how could you trade, not make people angry, and still build the volumes and still trade, as much as you could across multiple venues. And that's kind of where we grew out of. So the fact that we were small, it's a huge advantage because for me, making $10,000 in a day was a lot of money because that'd be a very good ROI on $1 million, right? But as a $1 billion hedge fund, they would say, well, don't even do that trade. That's not worth it. Yeah.
So how many prime brokers did you have? You had Citigroup, you said?
Citi was the main one. At any given time, we really focused on one because the whole point of our prime broker is to cross-margin your trades. But over time, we had several. We had BNP for a while. We had New Edge for a while. We had RBS.
I guess for people listening in, I mean, if effectively they're providing you with credit,
yeah, exactly.
And you got quite good at kind of tapping credit. But I mean, you were starting 2012, 2013. You were starting post the great financial crisis. The banks were all being heavily regulated, had lost a lot of risk appetite. Yeah. Tell me about that conversation. Like, how would you strike up a prime brokerage relationship? Like you're talking about how it's nice to be small and fleet of foot, and then you can get those high ROIs because you're small, etc. But kind of being small and significant to the bank who's providing you with the credit that has basically just reputation to lose because they're not going to make much money from your account. How did you manage to persuade them?
Well, first of all, they would make a lot of money from our account because our volumes were just as high as a multi-billion-dollar hedge fund. So in terms of the volumes, they absolutely would. In fact, that was part of how you onboard. You have to pitch a certain amount of business to them. You have to be able to pay, let's say, $500,000 of commissions a year, right? And so on a couple $1 million account to pay $500,000 of commissions is a lot. But if it's arbitrage and it's just high volumes, then it's not, right? But you also have to remember for FX, there were no prime brokers before 2008. They birthed out of 2008. That was the whole point. Like before that, banks would just have ISDAs against each other, right? And they would just assume that risk. After 2008, they basically came up with the idea that for the smaller clients, let's say a Millennium, they could sure have their own ISDAs. But for any hedge fund that was smaller, they would rather use one bank that would monitor all of the credit risk, and that would become the prime broker. So yeah, I think over time they figured out how to balance the credit across different counterparties. But they have their own risk management platform, and they would hedge things at a bank global level, right? So for them, it's not like they were taking enormous amounts. Like Citi was not taking a lot of Barclays risk. They would hedge the CDS, right? Because they had learned that lesson from 2008, where they maybe didn't hedge the rest properly, right? So yeah, it was not really an issue of taking enormous amounts of credit risk. It was rather using the credit that was already hedged for us. Yeah.
And so, when was the kind of the first proper calendar year as a hedge fund with no clients? That would be 13, 14. When would that be?
So we started in November 2012, and so I guess the full year of 2013 would have been the first year.
Okay, and I've not heard mention of what were those annual returns like when you were doing your FX arbitrage?
First year I think was 250%, something like that. Second year was 500%. No down months at all. Actually, very few down weeks. Period. It was an arbitrage book.
Yeah, we're like no down months, and between 200 and 500% returns trading FX.
Yep. Those are the glory days. You can still get those. You can still do some stuff on HFT spot, but frankly, the forwards market is like pretty arbed out at this point. At that time, I mean, you could. It was right when they were launching all the India futures as well. That was our first big complex. Just to give you an idea, the way you would trade the India complex is there are 3 onshore futures in India. And you could set up an offshore company to be able to trade this. There was a India rupee contract in Singapore. There was a new exchange, DGCX here in Dubai, that also had a new contract, which the INR contract was one of their biggest contracts. And then there was the CME. And so you had 3 onshore, 3 offshore futures contracts. You also had a forwards market. So that non-deliverable forwards, as a non-deliverable currency, people would trade it, it would settle into dollars, right? That's how you hedge your risk. And so it's a 7-leg trade. At any given point, you can trade one versus another. Parts of it you can automate, like the futures leg, you can write to their API, you can automate that. A lot of the NDF side you can't. It's still traded on chats. It's still traded on platforms that you have to click, because banks wanted that captive flow, right? But yeah, those were the days.
I still not really my language. No down months. Well, did you have a risk officer? I mean, did you think risk? Did we talk VAR?
We didn't talk VAR because we didn't lose money. We talked like credit risk. We talked about one thing that we were worried about is we could surely cross margin all the forward side, but we could not cross margin a future versus a forward. We had to margin those separately. And so there is a risk that, let's say you have a long position here and a short position here, that if the market goes up and then goes down, you could be liquidated on one side and you could lose lots of money. So these are the kinds of risks that we were worried about. But yeah, like it's not a VAR model kind of a business.
But I mean, you did give you expressed the trading fear, because trading is subject to the vagaries of life, etc. But what that never happened. Like you never had that disconnect where you ended up not being hedged just because of the path of some trade during a day
Well, it would have to be a pretty extreme move. We didn't really have any serious problems with that. Over time, by the way, we learned how to take more risk. So at first, the first 2 years was pretty much just straight arb, right? Actually, just to give the people an idea, that back in the glory days of FX, my best month was December 2014, which was Russian sanctions. And the reason it was so good for me is because my bank, Citibank, has credit lines with all different counterparties, right? Barclays, UBS. They also had one with Bank, which was the largest bank in Russia. And for me, it's all cross-margined in one beautiful little portfolio. For them, the credit's blowing up, right? And they had hedged it previously, I'm sure, but they're not pricing the credit properly. And so as the credit blows out, the onshore ruble is trading at a very different rate than the offshore ruble. And I can trade that. I can buy one, sell another, cross margin, and I can hold those positions. And they're forwards, right? So spot, I can just cycle. Forwards, I cannot. You have to hold those to maturity. But the spread is there, and so yeah, this was our biggest month, like by far, in FX, and it was a special time. But generally speaking, we did very well during periods of volatility. India elections was very good. Brazil elections was very good. Russia sanctions was the best.
Now you said that was December 14. What was the context for the Russian sanctions?
I don't know if they went through January of that year, and I don't know, all the all the currencies traded at crazy rates.
Oh, okay, and so and of course the focus of the fund did change once we come in to the crypto thing. But so the ARB, there was just more and more money chasing the ARB. I mean, there was nothing unique about your ARB. Yeah, I mean, like it was replicable by others, would have been, and slowly the returns were dissipated. Yeah,
exactly. So the half-life of this, I mean, the first week, I would have said it was going to last like a week or two, because I didn't know if counterparties would get upset and just close you off or whatever. Turns out it lasted years. But over time, banks got better at their pricing, and so more futures markets developed, and it was easier to know where the fair market was. So yeah, like by 2016, it was very hard to make money for us in that market. We tried other markets as well. We did spot. We actually were okay at trading, G10 currencies. We tried equities. We did index arb. We were trading around 15% of the Singapore stock market for a while, and Malaysia. Made no money. We were basically scratching. And we tried some options trades too, and got completely blown out. We mispriced options. And so we were just trying to find like the next foothold, because my philosophy at the time, and kind of still today, is that trading should be easy. If it's not easy, you're looking in the wrong direction. And the for me, anyways, my experience has been the initial trade is a point of some arbitrage. So in the case of an NDF, it was say, okay, this bank is trading here, this one's trading here. The hard part is, how can you make the most amount of money for the longest period of time doing this trade? And that was hard, right? That was figuring out bots, figuring out how to hire people to do this kind of trade, getting out onshore licenses or onshore entities to the extent that we could, setting up brokers everywhere to trade, for example, the Korea market, which we were very good at. You have to set up an onshore broker in Korea, and you have to be able to trade, spot in the onshore market, and you have to have an entity to be able to do that. And some of them you needed exchange memberships too. We were on the advisory board of SGX and KRX in Singapore and Korea, and so it was a full complex that you needed to figure out. But that was the exciting part, right? And then when we got into other areas, maybe we were late, maybe the volatility wasn't high enough, maybe we didn't have the expertise, but it was just hard. It was very hard for me to get a foothold. And it wasn't until we ventured into crypto in 2017, 18 that there was, again, a point of like pretty clear arb that we could maximize.
Yeah, so you essentially you spent several years just looking for new opportunities in different asset classes or different sectors
Yeah,
of it.
we made some money, but it was the thing about running a prop firm is your cost is high, your capital is low, your cost is high, and if you find something good, you make lots of money. But if you don't, your cost is high, and a 20% return doesn't cover your cost basically. So you need to be doing something that is more akin to market making or a finance balance sheet trade or things like that.
But again, just as I think of the model which has no clients and remuneration, like the typically like you have $1 billion of client money, right?
Yeah.
Let's say you make your 250%. Let's say you make 10%. There's a 100 million. You take 20% of that, so you take 20 million. But in your model, you basically one of your great superpowers was convincing people to give you lines of credit, so you get a.
It's not enormous lines of credit. I mean, it was we had a prime broker, right? All clients had the same thing. It was yeah, but it's just a prop trading firm. I mean, we were registered as a hedge fund. We didn't have to be. We set up that way because we initially intended to grow as a macro fund, basically. But yeah, we could have set it up just as a standard prop entity. And the normal remuneration for that kind of stuff is different, right? Like usually you pay, junior guys get discretionary, senior guys get a percent of their book. And yeah, because your sharps are much higher, you can afford to pay a higher payout, right? Like, so whereas a hedge fund you might charge 2 and 20, and you pay something like half of the 20 to the PM of that book, a prop trader might get 30 to 50% of their book because you're getting 100%. You're not charging 20, you're getting 100, right? But that said, you also need to be very, very careful about drawdowns, because if you have them, no one can get paid. So Millennium, for example, if you have 2 down months, you're out, kind of thing, right? And that's a big one. But like Tower, I think they have like a cutoff at like 5 sharp or something, right? So yeah, we were small, and I knew people that had small 30+ person firms that arbed Korean options or Japanese stock index or gold in particularly in India and Taiwan and Thailand. For us, it was NDFs, and we built up a firm specifically catered to doing that trade.
And you mentioned us, and it's, how do I say it, Suzu or whatever.
That's right.
So, and the relationship, the operational relationship, he was because like you were contemporaries, but was he your boss, or how did that work?
Well, so I don't think we were ever each other's boss. We were 50-50 partners and everything. And for the first 2 years, I was the one doing all of the execution. He was doing more of the operational side and coming up with ideas. And then over time, I don't know, I did HR, I did trading, I've done risk, I've done many different things. We probably both had every role at the firm. If I had to say what he's like a little bit better at, he's better at chats, which are important for a lot of OTC. So better at chats, better at ideation, like coming up with like initial new ideas. For me, I'm better at relationships. As an example, I do all the phone calls, he does all the chats, and I'm better at execution. So once we have an idea, like seeing it through and kind of following it through. But yeah, like we really did run the firm sitting next to each other for 10 years. So yeah, we've had every role.
At every role, right? But one of you wasn't the chief investment officer. It just depended on the moment. It was fluid.
It depended on the strategy too. So when we were small and we were trading like only one book of FX, it was kind of all hands on deck kind of a situation. As we grew bigger, the roles became more distinct. Yeah.
Okay, so then you finally see the opportunity. You see I guess the kind of craziness, the opaqueness, the emergence of crypto. But we're talking about that's when 17, 18 is when we came down from 20,000 to about 3,000.
Yeah. And that was the ICO craze. And I had some friends, a couple early employees that did really well. And we had known about crypto. We had traded some like on personal accounts in 2012, 2013, very small, suited a little bit more than me. He was doing something similar to the spot futures ARB that, we were looking at in FX as well. But it was just a very small market back then. Like, I think, and we didn't take it that seriously. It actually kind of annoyed me because I was saying, our FX business is doing so well. Like, why are you wasting your time with this Bitcoin thing? But by 2017, this was clearly not the case. The market had grown substantially, volumes were huge, and there was plenty of arbitrage to do. Just to give you an idea, like you could make 30+% just doing like a cycling spot through China. You could do spot futures arbitrage where you buy the physical Bitcoin and you sell a future, like let's say a 1 month tenor, and you could lock in an annualized 30+%. And this was possible because there was not a lot of credit at that time. So it was hard for people to borrow dollars, buy Bitcoin, sell future, and then slowly that ARB would converge. It was hard to do that. It was also, there was credit risk. So you had to trade on exchanges. Some of them went bankrupt. Actually, the one that Sue was trading on in 2013 did go bankrupt, and they took your money and they didn't give it back. So, there were plenty of risks. It was early days, and we saw there were definitely opportunities. And so for us at that time, we partnered with a firm in Hong Kong, small firm, senior guys, and we over a course of a year ended up injecting capital, bring everything in house, and then building upon that. And that was our start.
And so the futures, there were futures back then. I mean, tell me about it.
Yeah, it was I was actually BitMEX. So in 2013, it was ICBit. There were a couple other exchanges as well. And then BitMEX, they actually it was a perp, so a perpetual contract. Yeah, so it has a funding rate.
And you were scaling into that market. Like for you, at that point, did it matter if the price was falling a lot or going up a lot? I mean, in the evolution of that, where were you in terms of, because that was the first great bull, great bear. I'm trying to think where you came in on that.
Yeah, that's a good question. And so generally in a bull market, when the market's rising, the future would trade at a premium, and in a bear market, it would trade at a discount, right? Because that reflects the leverage in the system. It was a perp, by the way, so that's the funding rate, but it's the equivalent of a future trading above and below, right? And for me, it didn't matter at all because I was not trading like directionally. For some of our partners, it absolutely mattered, and they got wiped out, and so they ended up having to go back and get jobs. The firm did well. I mean, the firm made like pretty good money, but because of that, we ended up bringing everything in house, and that's why Sue and I ended up building everything ourselves. And eventually those guys ended up rejoining about a year later. They did very well. They were a lot of the brains behind it, a lot of the design. But yeah, the reality is like the market was quite volatile, and it was what it was. But yeah, for our strategy, it didn't matter at all. Actually, you just wanted volatility. So the more people would trade, especially in one direction, the higher the funding would go in one direction or another, and you could, collect your basis.
And so take me there. So you had 17 was kind of discovery, putting it in, and then 18, 19, 20 was just the volumes recovering from the aftermath of the huge price decline.
Yeah, there's so 18, a lot of firms got wiped out. It's kind of like now, right? Where a lot of firms are getting wiped out. and a lot of capital leaves the system. People lose interest. And this was our entry. And so we were lucky, frankly. If I had been maybe just a little bit earlier and caught some of the ICO craze, I don't know, maybe I would have been in that situation too. But I wasn't. I was lucky and good at that timing. And so for us, we were able to do this spot futures arb, collect that basis. And we always had this mentality that we had seen multiple cycles, and it had become more Lindy to us. That the Lindy, the idea that if it's happened more than the more it happens, the more likely it's going to happen again. And so we thought there's going to be another cycle. And as the market started to bottom, we started to build positions, and we would denominate all of our profits into Bitcoin or Ethereum. And that's how we started to build some of our early positions.
You're doing directional risk at this point, because up until that point, everything was flat.
It was not even that directional. It was just long. We would just build. Obviously we had some views on the market, but basically the idea was that there would be another cycle, and so we would denominate as much as we could, given that we were already earning like 30+% a year just in basis arb. So yeah, that's where we started to get some of our early positions, and I don't know. Do you have?
But I get your arb and kind of you're hedged until you're not, so to speak. But when you're just long, now we're back into a world where you do require to understand how much value at risk you have, how much of a pullback that you can withstand, and you didn't really have that wasn't appropriate, you say, for your FX book. Now it was kind of appropriate.
Sorry, I see the direction you're trying to go in. The first 2 years it was not appropriate because we took very little risk. The next 3 years that we were in FX, we had developed models to be able to absolutely take directional risk. The idea being that we would, let's say there's an arbitrage opportunity, okay? We can buy one bank, sell another. We would say, okay, which one's wrong? Well, the market's trending higher. This is the one that's wrong. This is the one that's stale. And so I would buy this one and I wouldn't hedge. And then I would build a position. It's not to say that I'm directionally think things about the market. It was just to say, I have a position now because I traded one side. And over the course of a day, you might buy, sell, but you would build positions, and you absolutely need to monitor your VAR. And also over time, we had traders who would build alpha and be able to actually express views on the market. We had a guy who could trade Southeast Asia. He's probably one of the best guys in the market, I think. And he could take multi-day, multi-week, multi-month views, especially in rates risk, and do quite well on a high sharp, because you have to remember we still had a prop model. So he had to do this on a pretty high sharp. But yeah, we absolutely understood VAR and how to take this risk.
Yeah. But you haven't really, but the metrics don't come in, and again, for people that think the sharp is just trying to reflect the returns you achieve versus the volatility, i.e. versus how much your book is subject to the back and forward. And, a one sharp ratio in the real world is good. And we're talking multiple sharp ratios, 4, 5, which are incredibly rare. I mean, they're just preposterous. But
our firm was 3+. Our firm was 3+ at all times. HFT firms would say not good enough. They would say 5, 10, 5+. But for us, we took directional risk, and we did take some risk. So for us, we were kind of in the middle.
But when we go 3, 5 times, whatever, what was the volatility? What was the underlying asset volatility?
So in FX, obviously, the volatility is not nearly as high as crypto, right?
And that's right.
Yeah, and so I mean, I agree with you. Your risk management needs to change as you trade more volatile assets. And at first,
let's put in context against a major the euro dollar cross, right, would have a volatility of 6 or something like that. Max, right. If we're in an NDF, the Indian rupee and stuff, could be closer to 10.
Yep. Actually, could be somewhere around there. And to give people context, that means it moves 2/3 of a percent a day, something like that. Bitcoin can be 50 to 100 vol. and even higher sometimes. So you're talking about it can move multiple percents per day. And so that absolutely needs to have different risk metrics. Our early days were, our mentality was we just put profits into Bitcoin. So we don't I don't really care about the volatility. I'd just say, I throw my profits into Bitcoin. If they go to zero, they go to zero. They're my profits. That was my mentality. And as we were lucky and good at timing, I guess, we did pretty well, actually. And so the biggest event for us in terms of the directional stuff for crypto was March 2020. So this was the COVID dump, caught everyone off guard. We were extremely well capitalized going into it. A lot of other firms were not. Any directional firm, it would have been very hard to do well during that period because the fall was just too much.
Price reversal, just again, context. So
yeah,
we're talking late February into March 2020. What are we talking?
So Bitcoin at its peak in 2017 was around 16K. It fell to it had been bouncing from 6 to 12 a couple times. And in COVID, it plummeted to 3.7K. And it actually only stopped because the primary derivative exchange, BitMEX, turned off. They just stopped the liquidity and they said no more. And actually there was a ton of ARB that happened at that level, by the way, too. You could have bought almost an infinite, because of the way the marks were handled, you could have bought almost an infinite amount with like $1 in your account at that specific time. And I knew people that did. But nevertheless, Bitcoin was extremely volatile and fell a lot more than people expected. And it wiped out a lot of people. I mean, there were other funds that went down during that period. But for better or worse, we're extremely well capitalized, and we took that opportunity to just say that we're all in. And that was where we really started.
You were always all in, right?
No, we were not. We will only put our profits into Bitcoin. This was the time where I put my whole book in. I had never been 100% long before. I had put my profits in, which were like 20-30% annualized on the spot futures basis and on Grayscale. That's the other trade we haven't talked about yet. But just for context, the way that Grayscale works is it is a trust listed in the US.
So
okay.
Again, it's just so you've had what 18 months or whatever, and you've accumulated profits, which is your directional Bitcoin's going up, right? And so you'd have had an average in price. Yeah,
exactly. We would have had an average in price based on every month we make money and we just keep it in Bitcoin.
And then you had this like awful shock to the system, and I've got to think your profits would have been reset to zero.
No, they wouldn't. Well, they would. So it went from let's say 6K to 3.5.
Yeah.
So you'd be down 40% on your profits.
Yeah.
Yeah. So if you were up, if 30% of the book was our profit since the beginning, you would now have 10% up instead of 30. Yeah.
So for you at the very worst, you were up 30-40%, say year to date or whatever, or into that campaign. And then at the worst point, you'd given back the profits.
That's the correct math, except we're up a lot more because of Grayscale, which we can talk about after. Yeah.
Right. Okay, well, let's do Grayscale.
Okay, so there were two main trades that we did at first, because as I said before, I always like to look for a point of ARB, and then my alpha is not really in even ARB trading. It is maximizing ARB. And so the second trade that we had was Grayscale, which was a US-based trust. At the time, it has a NAV, which you could subscribe in Bitcoin, but it traded above that NAV because there was no redemption mechanism. There was only a subscription mechanism. And the idea was that eventually it'd be converted to an ETF, and then it would trade around the NAV price. And as many of your viewers will know, that didn't happen, and so now it's actually trading at a big discount, right? And so
again, let's hold that a second, right? So Grayscale,
yep.
in some parts of the world, like the UK, that would be an investment trust. This is it's a perpetual raise. It's a perpetual sum of money. When did Grayscale? When did they launch in the US? It's a closed-end fund. In the UK, it's an investment trust. When was the original funding for that?
So they started in 2013, I think, but they didn't list until 2015, and that was the Bitcoin Trust. And then in 2018, I think they started the subscription for the Ethereum Trust, and then it launched in 2019. And I did the Bitcoin one a couple times. It was an annual subscription. Basically, you subscribe, wait 1 year, and then it becomes tradable, right? It vests. And if it's at a premium, you can sell it and you make some money and you feel good, right? And then you can cycle it again. The Ethereum one was where we killed it, though, because for us,
the Ethereum. I just wanted, because again, a lot of people go, and then we jump and they're like, oh bugger, can we go back? So you could go to Grayscale. Not everyone could, but professional investors or some
credit investors, all accredited investors,
like credit investors, and you could ask them to issue more, and that would take a year.
So you would actually have to send them. You could subscribe in kind, which would be Bitcoin, or you could subscribe in dollars, and you would send that to them, fill out a subscription form, and then you would wait the vesting period, and then at the end of the vesting period, they would send you. You could transfer shares to your Prime brokerage account. And you could trade them, basically.
And you were there for playing the fact that, and first of all, it traded at a premium. Typically, traded at a premium to NAV back then because it was just one of the only available routes for, if you will, onshore regulated savings products to get proximity.
You want to buy Bitcoin in your 401k? This is the only way, basically, or it was the best way. And now there's other options, but at the time, this was the best way. And in general, people want the biggest, most liquid one. So even if it's at a premium, they're like, you know what? It's in my 401k. I'm making it back on the tax anyways. It's the most, I trust this one. And so, the reality is, and Grayscale also did their part in marketing it very well to pension funds and, all the buyers, right? And so they kept the demand there going, which kept this thing at around 20 to 30% plus premium for years.
Now with the premium, let's just give them the arbitrage that you were doing there.
So I would take Bitcoin. So you have to start with Bitcoin.
Yep.
Then you send the Bitcoin to them. They subscribe at a NAV, right? And then you wait 1 year, and then they give you shares, and those shares can trade at any level, right? They can trade at a premium to NAV, below the NAV, like wherever they trade. And the reason being is there's the subscription mechanism, but there's no arbitrage to stop for the redemption, right? And so there's not a strong way for this to trade exactly at NAV, and that's why I trade at a premium. But you have to start from the premise that I want to be long Bitcoin, or you can borrow Bitcoin. That's where I was leading. You can borrow Bitcoin, and then I don't have the risk, right? You can also hedge out your Bitcoin. You can buy Bitcoin, you can sell a future or something like that. There are other ways to do it, and frankly, that would have been a decent thing to do for a lot of the period because the futures would also trade at premiums. In general, there was like this pent up demand for Bitcoin, right? And people would buy it in the trust, they buy it on the future, they buy it on the spot, and these things all trade at premium. So yeah, you could have bought spot, sold future, subscribe trust, and then sell share, buy future back. That would be like a full arb triangle. You could also borrow Bitcoin, you put it in the trust, and then and then sell the shares, and then rebuy Bitcoin and return your Bitcoin, right? That's like another triangle you could do. Or you could just be, I am long Bitcoin, and that's the simplest. If you're already long Bitcoin, then you just say, okay, I'd rather put these in the trust and I can earn some premium. But those are kind of like maybe the three dynamics of arb kinds of traders, depending on what their early positions were and what their access was. And yeah, people did pretty well with the Bitcoin one.
Okay. And so then came the Ethereum one, which is where
And it came the Ethereum one. And this is at a time, again, where people just weren't that interested in Ethereum. I think Bitcoin was about 70% of the total market cap of all crypto at the time. And Ethereum had just had all these ICO scams of 2017. And so people just weren't that interested. And there was a question of like, how much demand for this would there even be? After the trust vests, you needed to be demand for it to trade at a premium, right? Like, what if there's no demand? Then you lose money if you had a discount, right? But we had the strong view. We had a very strong conviction view that Ethereum was not a scam, that it was going to do well, that there would be demand. And so we decided we were going to be the biggest subscriber by far. And so, yeah, we took a huge percentage of the firm's assets and just said, subscribe them over. We waited a year. Over this period, Ethereum tripled, and the premium of the trust was 200 to 300%, something in that range, depending on when we sold. So this was a 6 to 10x kind of a trade, as it turned out, and that was where we really did well. Because the thing is, in the bull market, when everything's going up, lots of people have money, and there's a lot of competition for things. But this was a bear market trade. This was when this was like 2019, like early 2020, and so when we were able to do well, first with doing some futures basis stuff, but also doing this Grayscale and betting big on it, we were extremely well capitalized to then benefit from the bull market, basically. So at that point, we got into venture deals, we got into lots of other kinds of trades and some directional stuff, and that's really what got us going. Otherwise, it would have been hard. We would have earned our, if we were a dollar-based guy, we would have earned our 30%, and we would have done well, but it would not have been the multiple. We made 80x in crypto. It would not have been like that, basically, until we blew up. Then we went zero. But yeah.
But the Ethereum Grayscale was actually it had a beginning and an end. You talk to me about, you're like, okay, this trade's over, we've done it, like, let's move on.
So that would have been the smart thing to do. Hugh, if you were with the firm, we would have done better. So the way the trust works is you can keep subscribing. So after 1 year, we get our profits, we're high-fiving each other, we make 10x our money. Of course, we subscribe again, right? And so we subscribe again, and I think even that subscription did okay. But we just kept putting it in over time. It wasn't like discreetly year on year. We did like some every month over various periods. And at a certain point, there was not the demand for the Bitcoin and Ethereum trust, and they traded at discounts. And this is in large part due to the expansion of the credit markets. The 2020 to 2022, if you want to characterize like the crypto landscape, it's really a massive credit bubble. And that's part of what put all these trusts at discounts, because people could do them now with enormous amounts of borrowed money.
But eventually, so like you say, you got this great winning trade, and then suddenly everyone wants to talk to you, and then you're being shown a lot of deals, and then you get all these other coinage opportunities, and so where are, like, you had 30 people back in the day when you were FX. How many people did you get to when you were going through this?
Okay, if I were to count like every single person that like sat below us in some pyramid, maybe 45. I don't know, something on that order. But in general, we operated in groups at that time. So we had one that would focus on DeFi. We had one that was focused on NFTs. We had one that was focused on OTC trading. We had one that was focused on like basic arbitrage, and we had a tech team. So we got a little bit better at delegating. At first, I was quite bad at that, and it was basically like a flat, like 2 to 30. And over time, we figured out how to do a little bit more. But at the end of the day, we were really never that good at growing the firm that big. Other groups that were maybe some of our competitors or friends grew similar firms with similar P&Ls to over 1,000 people. we were not very good at that. So I don't know. On the one hand, maybe we would have had more institutionalized, and maybe a different kind of risk management or whatever. But on the other hand, if you hire 1,000 people, you also have no profits, and basically you have to build that out. So the balance would have been somewhere in between. And I've thought about maybe ways we could have done it better, but yeah, that's the way we did it.
But it sounds like all of it was frenetic, and it was just this, like, all of the energy, all of the effort was just like trying to make more and more money. And I guess your regret is, the risk system, the culture, the ability of people to come in and challenge, to have the debate, the dialogue. Sounds as if it was just, everyone was just like, on the screen trading, and
there was definitely an element of all of that. Yeah, I mean, if I had to say there was a specific area where we could, I could have. I like to think about processes, not about a specific trade. I wish I bought instead of sold or whatever. But in terms of the process, which I could have done better, the partners that we had that helped us start the original group got rich and wanted to retire, and we bought them out. And in the next 3 months, I doubled my money because the market just rallied straight up to through 60K. And I should have realized at that time that these needed, either we needed to retain them I don't care if they need to, they needed to stay, or we needed to bring in maybe twice as many people to fill partner level shoes. And we didn't. What we did is we just assumed the responsibility ourselves. And I think that was probably the beginning of the end, because we were not interested. That showed me that we were not interested in growing the firm, really. We were interested in just, holding in and trading, right? And I think if we had taken a different direction there, things could have been very different, basically.
Yeah. And so, but what did they own, the partners? They had a share of the vested profits in the.
Yeah, that's a fair point. So our structure was as a hedge fund. So in reality, what did they own? Nothing. They had a percent of a share class, which then could be redeemed. But we're business partners, so it's not like I would just force redeem. We were the directors. We could have just forced redeem them. Obviously, we're not going to do that. They helped us build the firm and all. And so the agreement we had was, we treat it as if it were ownership, basically, as if we own shares in the company. And so when we redeemed them, we had to buy out their shares. I had to pay for them in the equivalent amount, in whatever the NAV was. We priced it, but yeah, that's the way it was done.
Okay. So there's a lot of money floating in the system. You must be speaking all the time to people. So the whole financing. Because you were leveraged, you were leveraged. So let's talk. Can we say something to the leverage typically where you were?
Yeah, sure. So the way we thought about our book is we had a lot of spread trades. For example, if I trade spot versus futures, that is not a directional trade per se. Obviously, it does better in certain market conditions, but you buy Bitcoin and then you sell a Bitcoin future. If the market goes up, they move together, right? Kind of the same thing goes with borrowed Bitcoin for the trust. You borrow Bitcoin, you invest in the trust, you sell the shares, you return the Bitcoin. So again, it's market neutral. It does well in certain circumstances, you can test it through a VAR model, all that good stuff. VAR is not going to teach you anything about this because it's too new of a market, and I don't know how the premium would fit into VAR, but there are some ways you can think about it, right? And that's how we kind of conceptualized it. But then over time, the thing is, like I said, it was a credit boom bust cycle. At first, it was very hard for me to get 10 million to borrow. But then over time, the Grayscale was the name of the trust. There was an affiliate group called Genesis, both owned by DCG, the same parent company. And Genesis's job was to provide financing. So they did lots of borrow and lending. They had an OTC group as well for spot trading, but basically borrow and lending. And they worked together to lend to invest in the trust. And because of this business model, they would go out and say, we understand the trade you're doing. We're going to lend you a lot more than what we did before, hundreds of millions, right? At the end, billions. And it wasn't just that. There were other groups that came up because the borrow rates were high, because their spot futures was trading in the 20 to 30% range, and the Grayscale premiums are trading in the 30+% range. There are lots of firms that just pop up out of nowhere to be able to provide more borrow, and their business models are more or less to borrow from retail, to lend to hedge funds, or to do the trade themselves. A lot of them just operate as internal hedge funds, and this becomes an enormous bubble, because as more and more credit gets in the system, the arbitrage starts to drop, right? Same as we had in the FX days, where the spot futures now just trades like pretty in line. The Grayscale trusts are all at discounts. So over time, as more and more credit gets in the system, there's less and less opportunities. People start doing more and more risky things. And the next trade that we did was to do a lot of discounted layer ones. And so just to give you, I'll just finish this and then we can talk. But the idea of a layer one is protocols like Avalanche, Solana, near, Ethereum competitors, let's say, they raise money in an ICO. They have a lot of their token in their own treasury, and they want to diversify it. So they would sell it to groups like me at a big discount, 40 to 50% discount, but with vesting, 3 to 4 years, something like that, maybe 2 years. That's unhedgeable risk. There's no future. There's no liquidity to hedge this. You can't borrow that amount. It's just a risk you take. And still seems like a good trade, right? Like if you believe the market's going up, if you believe in this protocol, if you believe that they can take those dollars and do marketing or build their platform or hire more people and build value, then it looks like a very attractive trade. And so for us, we found several protocols that we liked. We did very sizable amounts with them. And that became another source of something that's set in the middle, where I would have considered it somewhat of like an ARB kind of trade. Like it is a discount, but it's very directional, right? It's not like you're punting Bitcoin, but it's somewhere in the middle. And yeah, over time, these strategies kind of develop. We also got very good at just directionally trading, Bitcoin and Ethereum markets as well. So over time, people end up doing more and more of this kind of thing, and then by the end, when credit gets squeezed out of the system, there's a collapse. Basically, that's what happened.
You described like the abundance of credit takes away the scalping profits from the art, and you're operating in an underlying kind of 50 vol environment, and then what you find is that your risk book is becoming directional.
Yep.
And with that direction, you probably, not probably, but there's a question of descaling. Like the holding, the amount of risk you've got to like hold less because to reflect that it's directional rather than hedged.
You would think so, but as credit becomes more and more abundant, the market's also going higher and higher, so our profits are higher and higher. And so the way these credit books would grow, it's not even like they would lend more dollars, or it's not we would post more dollars with them. A lot of these loans were collateralized. It's more that let's say I would have a lot of Bitcoin, and I would give them, $10 million worth of Bitcoin. But then Bitcoin triples. Well, now all of a sudden they can lend me $30 million, because in general you want to be borrowing dollars and you want to be lending crypto, right? That's the way that the ARB generally works. And so it's not really that as things become more risky, like we should have pared down the risk. Literally the opposite happened. I mean, maybe if you're a risk manager, it would have happened that way. But in general, the way the market developed, not the way it worked. We put in a certain amount of coin, the market tripled, quadrupled, kept going, especially in some of the layer ones. And then these firms are under pressure to lend out more and more too. You have to remember that the way they make money, they take these deposits, they lend them out, they earn the spread, but they're raising equity valuations, and some of these firms are raising at like one of the firms raised at $14 billion valuation, others at $3+ billion valuation. They really want to lend this money out. They can't afford for it to sit on the books, for one. They don't want to return it. So their risk management also starts to go down. And, that becomes the whole system, basically. I think one of the last calls we did, someone lent me, high 9 figures, almost $1 billion off a phone call. And it was that was the final one. That was like uncollateralized. And that's where the system was. Like, people needed to get dollars out the door. We were a hedge fund. We're paid to take risk. Yeah, I mean, the risk reward was like, we thought worth it, basically. And so that's where the direction went.
Yeah. Well, I mean, it sounds like you were operating on the basis that if they were as unprofessional, naive to give you that line of credit, then you felt duty bound to take it.
I don't know if I don't know if it was one way or the other. My mentality was, if there's any kind of trade that I think I can do, why not? Like, I can make this money. And to be fair,
like, things from that, but it's extraordinary that someone allocates you on the basis of just like a cartel. Yeah. Okay. The other side.
It wasn't just one guy, by the way. So at first, they would be fully collateralized loans. Then there becomes more and more competition. And so they compete with each other. They offer better rates, better collateral terms. And by the end, it's just like uncollateralized. And so, yeah, there's like that competition side. And then on our side, there's less and less things to do, but there are things to do. It's not like there's nothing to do. There are things to do. We did lots of discounted rounds right until the end that we thought were all like pretty solid.
So like there you were at your zenith. Can we talk about when you play it back now? You're like, oh bugger! Well, what was the? You think, why didn't I see that? What was the thing? Like, to give me some of that drama.
End of part 1. Intermission.